Welcome to Series 2 of The Algorithm Investor. In Series 1, we built the foundation, what the stock market is, how to open a brokerage account, index funds, ETFs, dividends, psychology, earnings reports, recessions, compound interest, and how to build your first complete portfolio. If you are new here and have not watched Series 1 yet, every episode is on the channel, and I strongly recommend starting from week 1. The link is in the description. Series 2 goes deeper. We are moving from foundation to fluency. Over the coming weeks, we will cover stock valuation methods, advanced ETF strategies, tax loss harvesting, options basics, reading financial statements, sector investing, international diversification, and the path toward financial independence. Today we start with what many experienced investors consider the most important skill in stock analysis: how to value a stock, how to determine whether a company is cheap, expensive, or fairly priced, and why that determination matters enormously for long-term returns. Most investors buy stocks based on one of two things: a tip from someone they trust, or a feeling that a company is doing well. Both approaches ignore the most fundamental question in investing: what is this business actually worth? A great company and a great investment are not the same thing. Apple is one of the greatest businesses ever built. But if you buy Apple at a price that already reflects everything good about the business, plus an optimistic premium on top of that, your future returns will be disappointing regardless of how well Apple continues to perform. Price is what you pay. Value is what you get. The gap between those two things, or the absence of a gap, determines your investment return far more than the quality of the underlying business. Today, we are covering 5 valuation metrics every investor should understand: the price-to-earnings ratio, the PEG ratio, price to sales, price to free cash flow, and the basics of discounted cash flow analysis. By the end of this video, you will be able to look at any publicly traded stock and form an educated view on whether it is cheap, fair, or expensive. Let us start with the most widely used valuation metric in investing: the price-to-earnings ratio, the PE ratio. The PE ratio is simply the current stock price divided by the company's earnings per share over the past 12 months. If a stock trades at $100 and earned $5 per share last year, the PE ratio is 20. What does that 20 mean? It means investors are willing to pay $20 for every $1 of earnings the company generates annually. Put another way, at that price it would take 20 years of current earnings to recoup your investment if earnings stayed flat. The average PE ratio of the S&P 500 has historically been around 15 to 17. A PE above that suggests investors expect above-average growth or are willing to pay a premium for quality. A PE below that suggests the market is skeptical about the company's prospects or the stock is genuinely undervalued. But PE ratios must always be understood in context. A technology company growing revenues at 30% per year deserves a much higher PE than a utility company growing at 2% per year. Comparing PE ratios across different industries without adjusting for growth rates leads to meaningless conclusions. This is where the PE ratio becomes invaluable. The PEG ratio, price to earnings to growth, takes the PE ratio and divides it by the company's expected annual earnings growth rate. It adjusts for growth so you can make fairer comparisons between fast and slow-growing companies. A PEG ratio of 1 is considered fairly valued. The PE ratio equals the growth rate. A PEG below 1 suggests the stock may be undervalued relative to its growth. A PEG above 2 suggests the stock may be expensive, even accounting for its growth prospects. For example, a company with a PE of 30 and expected earnings growth of 30% has a PEG of 1, fairly valued. A company with a PE of 30 and expected earnings growth of 10% has a PEG of 3, potentially expensive. The PEG ratio is particularly useful for evaluating growth companies where headline PE ratios can look alarming without the growth context. The third metric is price to sales, the PS ratio. This divides the company's market capitalization by its total annual revenue. It is most useful for companies that are not yet profitable, startups, early-stage technology companies, or businesses in turnaround situations where earnings are temporarily negative or distorted. A PS ratio below 2 is generally considered reasonable for a mature business. Between 2 and 5 suggest moderate growth expectations. Above 10 is aggressive territory, where the company needs to grow significantly to justify the valuation. The limitation of the PS ratio is that revenue alone does not tell you about profitability. A company can generate billions in revenue while losing money on every transaction. Always pair the PS ratio with margin analysis. Is the company moving toward profitability, and at what pace? The fourth metric is price to free cash flow, the most important valuation metric that most beginner investors never use. We covered free cash flow in the earnings report episode. It is operating cash flow minus capital expenditures, the actual cash a business generates after maintaining and growing its operations. Price to free cash flow divides the stock price by free cash flow per share. Like the PE ratio, but using real cash rather than accounting earnings which can be managed and manipulated. A lower price to free cash flow ratio generally indicates better value. Historically, the S&P 500 is traded at a price to free cash flow between 15 and 25. Individual companies vary widely. A company trading at 10 times free cash flow with growing cash generation and a strong competitive position is often an attractive investment. A company trading at 50 times free cash flow needs extraordinary growth to justify that premium. The fifth method is discounted cash flow analysis, DCF. This is the theoretically correct way to value any asset. It projects a company's future cash flows and discounts them back to their value in today's dollars using a required rate of return. The core logic is straightforward. A dollar received 10 years from now is worth less than a dollar received today because today's dollar can be invested and grow. DCF quantifies exactly how much less by using a discount rate, typically your required return, or the company's weighted average cost of capital. A basic DCF works like this. Project the company's free cash flow for the next 10 years based on historical growth rates and analyst expectations. Apply a terminal value to represent all cash flows beyond year 10. Discount all of those future cash flows back to today using your chosen discount rate. The result is your estimate of intrinsic value, what the company is theoretically worth today. If the current stock price is below your DCF intrinsic value estimate, the stock may be undervalued. If it is above your estimate, the stock may be overvalued. The gap between current price and intrinsic value is called the margin of safety. The challenge with DCF is that small changes in your assumptions, particularly the growth rate and the discount rate, lead to dramatically different intrinsic value estimates. DCF is a framework for thinking clearly about value, not a precise calculator that spits out the correct answer. This is why experienced investors triangulate across multiple methods. If a stock appears cheap on PE, cheap on price to free cash flow, has a PG below 1, and a DCF analysis suggests meaningful upside, the convergence of multiple methods creates genuine conviction. If only one method suggests the stock is cheap, while others suggest fair or expensive value, that is a much weaker signal. Let us apply these 5 metrics to a practical example. Imagine a consumer technology company trading at $150 per share, earnings per share of $5, PE ratio of 30, expected earnings growth of 25%, PEG ratio of 1.2, annual revenue of $20 billion with a market cap of $60 billion, PS ratio of 3, free cash flow per share of $8, price to free cash flow of 18.75. Walking through the metrics, the PE of 30 looks elevated on an absolute basis, but the PEG of 1.2 is close to fair value when growth is considered. The PS of 3 is moderate for a technology company. The price to free cash flow of 18.75 is actually quite reasonable. Earnings are lower than free cash flow, suggesting high-quality accounting. The overall picture is a company trading at a moderate premium to fair value with strong free cash flow generation and reasonable growth expectations. Not obviously cheap, not obviously expensive. The kind of stock where conviction in the business quality and growth durability would determine whether it is a compelling investment. This is what valuation analysis actually looks like in practice. Not a single number that tells you buy or sell. A mosaic of metrics that together paint a picture of how the market is currently pricing a business relative to its fundamentals. The most important habit to build from today is to never look at a stock price without also looking at least two valuation metrics: PE and price to free cash flow for most established companies, PE and PS for companies without reliable earnings, and always the PEG ratio when evaluating any growth stock. Make this a reflex. Price is a number. Valuation is context. You need both to invest intelligently. Next week on The Algorithm Investor, Week 12. We are covering tax loss harvesting, one of the most powerful and most underused tax reduction strategies available to investors with taxable brokerage accounts. We will walk through exactly how it works, when to use it, and the wash sale rule that catches most investors off guard. For the full breakdown on everything you need to build real wealth, subscribe to The Algorithm Investor. New video every single week. Drop a comment below. Which valuation metric do you find most useful or most confusing? I read every single one. See you next week.